There's a company you've probably never heard of. It's Korean, and it was born during one of the worst financial crises in Asian history. And today, it's moving billions of dollars between Korea and the United States every single month. But here's the thing. The way that money is moving and the direction it's starting to shift is one of the clearest signals we have right now about where the global economy is heading. And if you have any money in the market at all, what's happening inside this one company is actually about you. The company is called Mirae Asset, and today we're going to use it as a lens to read the economy. Act 1. How a crisis built a bridge to Wall Street. It's 1997. Korea is in freefall. The Asian financial crisis has hit, and the Korean won has collapsed almost overnight. Companies are going bankrupt by the hundreds. The government has to go hat in hand to the IMF for an emergency bailout, one of the most painful economic moments in modern Korean history. Unemployment spikes. The middle class gets wiped out. People are melting down their gold jewelry to help pay the national debt. In the middle of all this, a man named Hyeon-joo does something that sounds almost crazy. He starts an investment fund company in Korea in 1997. His belief is simple, that ordinary Korean people deserve real investing tools, not just savings accounts at the local bank. That company is Mirae Asset. And nearly 30 years later, it manages roughly $730 billion in assets globally. That's bigger than the GDP of Switzerland. It operates across 13 countries and runs over 600 ETFs on exchanges around the world. And in 2018, it bought a US company called Global X, one of America's ETF providers, for a price that looks like a bargain today. At the time of that acquisition, Global X had about $10 billion under management. Today, it has $73 billion. That's a seven-fold increase in 7 years, growing at nearly double the pace of the broader US ETF market. A Korean company born in a crisis, now running one of the biggest ETF brands on Wall Street. That's already a remarkable story. But the more important story is why Korean money started flowing toward the US in the first place, and how much of it eventually came. From 2012 to 2022, the average annual return of the Korean stock market was 1.9%. Not 19, not 9, 1.9% per year over a full decade. Over that same period, the S&P 500 returned roughly 15% annually. That gap didn't go unnoticed. The reason Korea's market underperformed so badly has a name: the Korea discount. Korean-listed companies have historically traded below what their actual assets are worth. The average price-to-book ratio for the Korean market has sat around 0.99, meaning the market values these companies at roughly what they own on paper, with almost nothing extra for future growth or good management. Most markets trade at a premium to book value. Korea has traded at roughly book value or below for years. Why? Because of a structural problem buried inside how Korean companies are run. Korea's economy is dominated by massive family-run conglomerates, the chaebols. Samsung, Hyundai, LG, Lotte. For decades, these groups were structured in ways that benefited the controlling family first and outside shareholders second. Profits were recycled inside the group. Dividends were kept low. Minority investors had very little power to push back. Foreign institutional investors saw this pattern, got frustrated, and pulled their money. Korean retail investors watched the foreigners leave, looked at their own returns, and eventually made the same call. Then, in December 2024, the political situation added fuel to the fire. The sitting president declared martial law. It was reversed within hours, but the damage to investor confidence was immediate. The won dropped sharply, foreign capital fled, and millions of ordinary Korean investors watching from the sidelines drew their conclusion. If the big players are leaving, so am I. So where did they go? Into the one market that had proven it could deliver, the United States. And Mirae Asset was right there with exactly the right product. Their flagship fund, the Tiger US S&P 500 ETF, became the largest ETF by net assets ever listed in Korea. The first time in the country's 23-year ETF history that an overseas stock fund took the #1 spot. Korean retail investors made it their single biggest net purchase in both 2024 and the first half of 2025. A fund that tracks American stocks with a Korean nickname. Act 2. When the guy selling the product starts warning you about it. By late 2025, the numbers had become extraordinary. Korean individual investors had become the single largest foreign buyer of leveraged US ETFs on the entire planet, holding an estimated $15.6 billion in these products. In October 2025 alone, they put in $6.8 billion in a single month. November added another $5.6 billion. The full year 2025 set the all-time record for Korean retail outbound stock buying. And as of mid-2025, nearly 29% of their overseas ETF holdings were in leveraged or inverse products. Let's pause on that last number. Nearly 1 in $3 Korean retail investors had in overseas ETFs was in a leveraged or inverse product. These are not plain vanilla investments. A 2 times leveraged S&P 500 fund doubles your gains when the market goes up, but it also doubles your losses when it goes down. And because of how these funds rebalance daily, if you hold them for a long time through volatile markets, the math can quietly eat away at your money even if the market ends up roughly flat. Korean regulators got alarmed enough that starting December 2025, they required mandatory investor education before anyone could purchase these products. The government even offered tax incentives specifically designed to lure investors back into the domestic Korean market. Think about that. A government using tax policy to compete against the S&P 500 for its own citizens' savings. But here's the moment that should make you stop and pay attention. The man who built the products driving all of this, Mirae Asset Chairman Park Hyeon-joo, started sending a very different message. Starting in late 2024 and through 2025, Mirae began rolling out China-focused investment products. They published investor guides on Chinese sectors, they held seminars redirecting attention towards markets outside of the US, and Chairman Park said publicly that he believes Korean investors are dangerously overexposed to US assets. The person profiting most from Korea's love affair with US stocks is the one telling investors the love affair has gone too far. And he's backing it up with action. Mirae Asset made significant private investments in SpaceX and XAI, Elon Musk's rocket company and his AI company. Those bets have almost certainly generated large gains. But rather than using those profits to buy more US stocks, Chairman Park announced he will redeploy those gains into global mergers and acquisitions, building businesses across multiple countries, diversifying away from any single market. He called this moment a historical inflection point in global finance. That phrase, historic inflection point, is worth sitting with. When the largest Korean asset manager starts hedging away from US exposure, while Korean retail investors are still piling in with leverage, that is a meaningful divergence. Institutions and retail investors move in different directions all the time. But when the divergence is this sharp, this visible, and this openly stated by the person running the shop, that's a signal. Not a guarantee of anything, but a signal. And the institutions agree. BlackRock entered 2026 with reduced US equity exposure in their models. Goldman Sachs noted that the US market's combination of elevated valuations, extreme concentration, and strong recent performance resembles a handful of historically overextended markets from the past century. Cambridge Associates found that stocks outside the US outperformed US stocks by more than 11 percentage points in dollar terms in 2025, and they expect that trend to continue into 2026. The top 10 companies in the S&P 500 now make up more than 40% of the entire index. The equity risk premium, the extra return the market offers you for taking on stock risk instead of just holding bonds, is near its lowest point in decades. The easy, obvious trade of the last decade, i.e. the S&P 500, is getting very crowded. Act 3. What this means for Korea, for the US, and for you. So let's connect the dots. Because the Mirae Asset story is not just about one company or one country, it's a window into something structural that's been building for years and is now reaching a point where it matters for everyone who invests. Start with Korea. When Korean investors buy US stocks, they have to convert their Korean won into US dollars. That means they are selling won and buying dollars, and that constant selling pressure weakens the Korean currency. A weaker won makes everything imported more expensive: fuel, food, industrial materials. That feeds inflation inside Korea. And when inflation is a problem, the Bank of Korea can't cut interest rates freely to stimulate the economy. So the very thing Korean investors are doing to protect their own wealth, moving money to America, is inadvertently making the Korean economy harder to manage at home. The domestic market underperforms, investors leave, the currency weakens, economic pressure increases, and the domestic market underperforms more. It's a loop that feeds itself. The Korean government offering tax breaks to compete against the S&P 500 is not a minor footnote. It is a government admitting that its own capital markets have lost the trust of its own people and scrambling to get it back. Now look at the US side. Here's the part that doesn't get nearly enough attention. The strength of the US stock market over the past decade has not been driven solely by American investors or American economic growth. A very large and growing portion of it has been driven by global capital flowing in from all directions. Korea, Japan, Europe, Taiwan, everyone moving into the same US index funds and the same technology stocks. That global demand inflates prices beyond what American fundamentals alone would justify. Think of it this way. If everyone on your street agrees to keep buying the same house over and over, the price goes up. Not because the house got better, but because everyone crowded into it. US equities have had that dynamic working in their favor for years, but prices built on capital inflows are only sustainable as long as the inflows keep coming. And here is where the medium-term picture gets genuinely interesting. A few weeks ago, I attended the annual CFA Investment Strategy Dinner, and the keynote speaker was Gabriela Santos, Managing Director and Chief Market Strategist for the Americas at JP Morgan Asset Management. She was bullish on global assets, not US assets specifically, global assets. That framing is intentional, and it's very important. When the chief market strategist for the Americas at one of the world's largest asset managers comes to a room full of investment professionals and frames her optimism around the world rather than around the United States, that is a deliberate signal about where she sees opportunity shifting. And she's not alone. Cambridge Associates found that non-US stocks outperformed US stocks by more than 11 percentage points in dollar terms in 2025 and expects that gap to continue in 2026. BlackRock entered this year with reduced US equity exposure. Goldman Sachs has flagged that the US market's current combination of high valuations, extreme concentration, and strong recent returns resembles historically overextended markets of the past. What happens if those flows actually start reversing? It doesn't require a financial crisis. It could be something as simple as Korea's own corporate governance reforms, which are happening right now, making domestic stocks more attractive to investors who left. Or it could be rate differentials shifting. It could be a weaker dollar. But when global retail money that spent a decade flowing into US equities starts rotating toward other markets, the outflow itself becomes an accelerant. The same mechanism that pushed prices up on the way in pushes them down on the way out. And the people most exposed are not the institutions who are already quietly repositioning. The most exposed are retail investors still holding leveraged bets on the most crowded trade on Earth, the S&P 500. So what should you actually do with all of this? First, don't panic. This is not a prediction that the market crashes next month. US earnings growth is real. The structural advantages of American capital markets are real. There are serious analysts who still see solid returns ahead of US equities in 2026. But understand what you own. If your portfolio has grown significantly because of US equity exposure over the last 5 or 10 years, a portion of that growth was carried by global capital flows that are now showing early signs of shifting. That doesn't make your gains fake, but it means the tailwind you had is becoming less reliable, and you should not count on it at the same strength going forward. Third, think seriously about what real diversification means for you right now. Not just mixing US stocks with US bonds, but genuine geographic diversification. Non-US developed markets, selective emerging markets, the kind of portfolio that doesn't depend entirely on global money continuing to flood into US equities. This is exactly what the smartest institutional money in the world is quietly doing right now. And it's exactly what Chairman Park, the man who built the bridge that carried all the Korean money to Wall Street, has started doing with his own firm's profits. Mirae Asset was founded by someone who built a company that survived and grew through multiple crises because he always kept asking where the next risk was coming from, not just where the next return was coming from. And that's the question worth asking right now. Not just where has the money been going, but where it is starting to go next.